to give you a background, as a community foundation, we work with donors to help them support the causes and the charities that are close to their heart. We manage over 700 funds set up by individuals, businesses, and nonprofits. The funds set up by individuals provide the support for the greatest needs of our community during their lifetime and through their legacy gifts after they're gone. We have a strong network of professional advisors in Central New York, and we're a resource for them to help their clients utilize many charitable planning tools we provide here at the Community Foundation. It's important for advisors to bring up charitable giving with their clients and also present various options of charitable giving strategies to help fulfill their charitable wishes within their financial and estate planning, while also maximizing their tax incentives. We work with tax accountants, estate planning attorneys, financial planners, and life insurance professionals. And a lot of the times, these different types of advisors work together on a charitable plan and collaborate for a common strategy for their client. It's important that all advisors collaborate together for the benefit of the client's planning goals. And that's why we have, the three panelists from three different planning fields. And all three speakers today serve on our professional advisor council and are well-known experts in their respective professions. They will share how they work with their clients to use some flexible planning tools that we offer here at the Community Foundation. So I'll go ahead and introduce our panelists, starting alphabetically. First, we have Ray Grimaldi, Senior Counsel at the Bonadillo Group. As Senior Counsel for the firm, Ray is primarily involved in tax, estate, and financial planning and consulting for businesses and individuals. He has 55 years of experience. Ray serves on other professional boards, such as the State Planning Council of Central New York and Financial Planning Association of Central New York. He is also the board treasurer for the Onondaga Historical Association. Thanks, Ray, for being here today.
Thank you.
Next, we have Marie Norquette, Wealth Manager of Capital One Investing. She is a certified financial planner with a demonstrated history of working in the financial services industry. She is skilled in strategic, comprehensive financial planning, including estate and trust administration, tax, and charitable strategies. Marie was a former member of CNYCF. Marie is also a member of FP of Central New York and has served on other nonprofit boards, such as the Junior League of Syracuse as Fund Development Vice President and Treasurer. Her hobbies include Taekwondo training, gardening, tennis, and family outings. That sounds so much fun. Thanks, Marie.
Thanks for having me, yes.
Next, we have Rob Scalaro of Scalaro Law PLLC. Rob is running a little bit late today, so he'll be joining us a little later. But just to, Rob has over 21 years of experience helping families and family-owned businesses meet their estate, trust, business, succession, and tax planning needs. He counsels clients on aspects of estate, retirement, business succession, and tax planning, asset preservation, probate and trust administration, family-owned businesses, real estate, private foundations, charitable organizations, and elder law matters. He just does it all, and that's why he's running late today. So Rob is a member of the board of directors of and a past president of the Estate Planning Council of Central New York, and a former board member at the Community Foundation, Tully Hill Corporation, and Tully Hill Foundation. So thank you all for your time today and your willingness to share your knowledge with us. All right, to get the discussion started, I will start with donor advised funds, or DAFs, as you might hear me referencing it as DAFs on this call. So donor advised funds are are popular among our donors at the Community Foundation as they're less administratively cumbersome to set up and administered compared to private foundations. Donors can make gifts of cash, stocks, real estate, or other assets and receive the tax deductions immediately that year. Then they can distribute funds to the qualified charities on their own that they care about on their own timeline. And a lot of our donor advised fund holders also find this tool helpful for succession and legacy planning and engaging children and grandchildren in grant making decision and introducing philanthropy early on in their lives. So with that said, Marie, would you mind telling us from your perspective as a financial planner, how you have worked with your clients in regards to recommending donor advised funds and what your experience and the client's experience has been? Perhaps walking us through a client scenario would be helpful for our audience.
Sure, happy to. And thank you for having me on the panel today with my esteemed colleagues. But when it comes to financial and investment reviews with clients, in reviewing their investment statements and their tax returns, which are a wealth of knowledge, it often becomes apparent that they are charitably inclined and they may have concentrated stock positions. Maybe they've worked for the same company for a long period of time and they've participated in their employee stock purchase program, or they have stock options or something like that. So as we're going through reviews, it kind of pops to the surface that, okay, they are charitably inclined. They may have concentrated stock positions, which adds risk to their portfolio if they have most of their eggs in one basket, so to speak. They may also have highly appreciated securities, whereby if they've worked for this firm for a long period of time, they might have bought stock back in the 80s and 90s at, say, $10 a share, and currently those share prices are now $100 a share. So we look at highly appreciated unrealized gains, and so we take that into account. And then we also look at whether or not the clients need cash or rebalancing. And when it comes to raising cash, what assets do we sell? Assets that are highly appreciated, we have to take into account the long-term capital gains and the tax associated with that. So all of these things kind of come to surface as we're meeting with clients, which then prompts the question, well, I see that you're charitably inclined. Have you ever heard of or considered a donor advised fund so that we can take advantage of some of these more efficient and effective means of contributing to your favorite charities?
Great, thank you for that insight. And this is probably one of your busiest time of the year too, right? Looking at your stock portfolio of your clients right now.
Right, because a lot of these things have to be done by year end in order to meet the tax filing deadlines. So yes, that prompts the question. And if folks are, sorry, I got a poll popping up in front of me.
No, just go ahead. That's for the CFP code. Sorry about that.
So if folks are charitably inclined and they are curious about the donor advised funds, we kind of dive into, you know, what are the pros or cons of considering a donor advised fund, and for many of the reasons that I just referenced, and also some of the things that you talked about, Pragya, you know, extending their charitable intentions to their family and as the legacy, and supporting their passions in the community. All of those things come into conversation. And as an example, I can say in many cases, we do have clients with company stock and large concentrated positions. And then the conversation revolves around, well, how do we exit these highly concentrated positions without creating a huge tax bill? And when we talk about donating stock to a donor advised fund, I explain to them that even though you purchased the stock for perhaps $10 a share, and now it's worth $100 a share, if you were to sell that stock you'd realize the capital gains on that appreciation, and you'd pay tax on it. And then you would make your donation maybe in cash to charity. Well, there's a more efficient way of doing that, whereby instead of selling the appreciated stock and donating cash, you could actually donate that stock itself in kind to your donor advised fund, and you'd get the higher level, the fair market value, as your donation and be able to deduct that. And because you donated the stock to charity, you would never pay capital gains because you never sold it. And the donor advised fund, being a charitable or run through a charitable organization, when they in turn sell that stock to diversify, they don't pay tax either. So that really piques interest and kind of opens up a new door for people trying to de-risk their portfolio and make charitable contributions and be tax efficient. All of those things kind of roll up into one.
Yeah, it's a win-win situation for the charitably inclined client to support the causes that they've been supporting, already. So great, thank you for that insight. I want to talk about the Tax Cut and Jobs Act of 2017, which nearly doubled the standard deduction for taxpayers for individuals from $6,500 to $12,000. For married couples from $13,000 to $24,000. So as a result, this tax reform reduced the number of taxpayers who needed to itemize their deductions, dropped significantly. The new tax law also capped the SALT, or the state and local tax deductions, at $10,000 per year for households who itemize when filing federal taxes to deduct certain taxes paid to state and local governments. So the next question is for Ray. Ray, would you mind explaining how that tax reform of 2017 has impacted your clients in terms of their charitable giving, and what other charitable giving strategies you suggest to your clients who are significantly impacted by this tax reform?
Well, to reiterate to what you have already said, the Tax Reform Act reduced the items you could deduct with the SALT deduction limited to $10,000. So if you limited the SALT deduction to $10,000, then the SALT deduction, as most people know, you limited the real estate taxes, the income taxes, and all those related taxes that go within that category, as well as itemized deductions, which were also previously at a 2% limitation. Now these itemized deductions are not deductible at all. So if you limited the SALT deduction, which is a big deduction in New York State, on top of that, you would have charitable contributions, you would have real estate and other taxes limited to $10,000, medical expenses, which you don't really see that often, and those would be and the interest deduction. And the interest deduction was also limited. On a mortgage, it was limited to $750,000, and that was a phase-in, very complicated. So by increasing the standard deduction, doubling it, and they keep on increasing that for inflation each year, they were trying to eliminate people taking a lot of trying to eliminate people doing itemized deductions, reduce the returns, as Trump was saying. He's going to put it on a postcard. But of course, he didn't explain about the 6 schedules that went with it. So more confusing than anything else. So he did accomplish that, because what happens there was 37 million people that itemized in 2017. And in 2020, there were 12 million people that itemized. So the amount of people that itemized was reduced by 25 million. So then he did accomplish a lot. The problem was, of course, you're losing a lot of deductions. You're losing your charitable deductions. So we concentrated on the 3 items. That's bunching deductions. When you bunch deductions, you can enhance it by leveraging contributions to donor advised funds. Qualified charitable distributions, which became more popular, and donating appreciated certificates, stock certificates, and other sophisticated assets. retouched upon. So if you look at the bunching of income, with a simple example, if you take, let's say you're donating $10,000 a year for 3 years, and you had mortgage interest of $6,000, and your SALT deduction was limited to $10,000. So if you look at those, you had charitable donation of 10, mortgage interest of 6,000, the SALT deduction of 10,000. So for 2021, you'd be $900 over the standard deduction. So that would be $315 of savings. So if you said, well, I'm going to take these 3 years and bunch them together, the thing you would bunch together would be your charitable donations. So we would recommend you put those into a donor advised fund. So if you took $30,000 in 1 year, you put those into a donor advised fund, and then of course the other 2 years you would take the standard deduction. So you would have your $10,000 over 3 years, but you took your deduction all in 1 year. You're still getting your standard deduction. So if you took that in 2021, you'd be $20,000 over the standard deduction, which would give you a total savings of $7,000. So that would be decent savings for someone who's putting in $10,000 each year. Now you say, well, maybe I don't want to put in $30,000. You're already putting in $10,000 each year. So now you can put in, you're only putting in $20,000 more. Now, if you did more, it would probably be worth more to you. You'd have to put a pencil to it, see how it worked out. I've recommended this to several clients. I don't know if any of them done it. None of them come back to me with it. One client I had a conversation with, he said, well, it wasn't worth it. So I asked him to write me a check for the savings, and of course, he denied, he didn't want to do that. So I just, everything is relative. This person made a lot of money, so he didn't think it was that important. If I didn't bring it to his attention, he probably would have thought it was important. If someone else brought it to his attention. So we worked with him, and that could be a tremendous savings, because once you got $10,000 and you bunch them up for 3 years, the nice thing about the donor advised fund, you still have control over the donations you're giving. So if you're giving, to make it simple, your college $10,000 a year, you could still spread that contribution over 3 years. So I think it's I think that's one of the best things that came down the pipe. And I often talk to clients about it and recommend it. So that would be number one. Your qualified charitable distributions, as you know, those are when you're getting required minimum distributions. And you have to be 70 and a half to do that. Even though they changed the law now that you have to be 72 to qualified charitable distributions, it's still be 70 and a half to do a qualified charitable distribution. So you simply call up your people that are holding your retirement assets. You say, I want to make a contribution of $10,000 to my favorite college. Well, then if I had to take a qualified charitable distribution that year of $80,000, I would still get a 1099. That's 1099-R that shows I had an $80,000 distribution. And I would be taxed on only $60,000 of that. So as a notation, those people who deal with tax returns, and those people here that have someone else use a tax return, the 1099-R still shows the entire distribution. So let your tax preparer know that there wasn't $20,000 or whatever amount there was of a qualified charitable distribution. Because if you don't say something, your tax preparer may not know that. When I did some of mine, I did get a lot of paperwork done with it, even though my 1099 still showed it. But of course, 2020 was a great year because I put it all back. So, I saw some people didn't put it all back. So I questioned them on it, and they said, well, my advisor didn't tell me. Most advisors I know are really good. I really thought, well, you weren't paying much attention. I didn't tell them that. Not a good place to go. So the qualified charitable distributions are really almost a no-brainer. It's so easy to do. One client I had, he decided to take the distribution and he wrote a check to the charity. That's a no-no, so he wasn't entitled to that. Your qualified charitable distribution also reduces your adjusted gross income. You have all of these things in the tax code that are interrelated. And one of the things you want to keep in mind is that your adjusted gross income, especially if you're in that area where you have a qualified charitable distribution, that personally can affect, well, it positively affects your adjusted gross income because it reduces the top line. It doesn't go on Schedule A. It reduces the top line, which reduces your adjusted gross income, which possibly could save you money 2 years from now on your Medicare Part B and Part D deductions. Because if you look at those, I mean, it's not a phase in or a phase out for Medicare. It's a drop dead bound. Now, if you get to a certain number and you go to another category of having a higher deduction for that. So that could get pretty steep. If you're in a top deduction, I think it goes up to about $600. So if you're married filing jointly, that could be $1,200. So, you know, that's something you often overlook. It takes a little more work to do it, get people to cooperate. But it's really important to keep that in mind because a lot of things are dependent on your adjusted gross income. Could be the STAR deduction, perhaps. It could be some credits, children, if you have children, where you fall in with the various tax breaks and credits that have come down the pipe. So that is, that's really important to watch that. There's all these unintended consequences that you run into. And, so those are the two big items, as well as the donated appreciated stock and there's other sophisticated assets, which Marie mentioned. I think you have that as the next question.
Thank you, Ray. And then Marie, you know, can you give us a scenario perhaps you've had with clients that were impacted by the same 2017 tax reform in terms of their charitable giving and how you advise them to maximize their giving and tax deductions?
Absolutely, in the same vein as Ray mentioned, when bundling those charitable contributions, you know, again, if somebody's donating $10,000 a year as a regular, as a normal rule of thumb, and you explain that, you know, you're really not getting a benefit of these charitable contributions, and most people are not only concerned with the charitable deduction, you know, they're giving out of the goodness of their heart because that's their passion and that's what they want to support. But if you explain to them that, look, if we take advantage of some of the strategies that are available, such as bundling these donations in a single year, you can actually receive a tax benefit as well. And it could be substantial. So when you kind of break it down for them year by year, say, okay, you donate $10,000 as a rule every year. Well, over the course of 5 years, you've donated $50,000, of which you've not received any tax benefit for because you're under the standard. So when you show them that, look, if you donated $50,000 in year one, you will get a significant deduction from your income, which then could also allow you to implement additional tax strategies such as a Roth conversion. And so you start explaining all the different spokes in the wheel that can kind of benefit the client tax-wise in doing this bundling in year one. And they say, oh my goodness, that does make a significant impact long-term. And it probably does make sense. And then the other thought they have is, well, I don't want to donate $50,000 in 1 year to these charities, because then what am I going to do for the next 4 years? And that's where you know, kind of define what the donor advised fund flexibility offers. You don't have to donate it all in 1 year. As a matter of fact, if it's 50,000 or above, they can actually, the community foundation can actually invest that money for you, so that by the end of 5 years, if you donate $10,000 a year, you may still have additional monies to donate from those investment gains. So it's, again, it's a win-win all the way around.
That's great. And that's what we, you know, tell individuals and families coming in. It's like a charitable giving account. You know, they get the tax deduction the year that they open the fund, and then throughout the year, they can continue to support the, you know, causes that they care about. So yeah, like you said, it's very flexible. All right, so shift to another area of topic is that according to Giving USA 2020, the annual report on philanthropy for the year 2019, charitable giving mainly is driven by individuals. 68% of the charitable giving in 2019 attributed to individuals and families giving. A lot of our fund holders and donors come to the community foundation to create funds, knowing that they can use other complex assets other than giving cash, like Ray mentioned earlier. So Ray, just going back to that, can you go over some of the benefits of using other assets, such as highly appreciated assets or stocks for charitable giving for our audience today?
Okay, well, the least complex, the easiest one to explain would be securities that have increased in value, which Marie touched on earlier.
Mm-hmm.
So to continue her example, let's say you had, I had a guy the other day said you had $10,000 in Apple stock. I said, wonderful. He's got a low base because he's had it forever. And he typically gives his Apple stock to the charities that are close to him. So let's say his Apple stock is worth $10 a share. And he had it so many years, he had all of his splits. So now the Apple stock's around, I don't know, $150 a share, give or take. And he gives to his charity, and he wants to give his college $15,000. He can take 100 shares of the Apple stock. He's given the college $15,000. His original cost of that is only $1,000. So if you were to sell that, you'd have a $14,000 gain. So the bad thing to do is I'm going to give my college $15,000. I can cash my stock or I'll write a check out of some other account. So he's avoiding the capital gain on $14,000. Keep it modest. Let's say he's in the 30% bracket. He's going to save $4,200 on that $14,000 gain that he's not taxed on. So he's giving the stock to the college. He's got a $15,000 deduction. So it's sort of doubling up. Not only does he avoid the tax on the capital gains, but he's also still getting his $15,000 deduction. Now, if he gave that to a donor advised fund, he'd have the same result. But when you have the other assets other than cash, he's limited to 30% of his adjusted gross income to a donor advised fund. So there's a limitation. If you went to a private foundation, the limitation is 20% of adjusted gross income. So you all have to be aware what your adjusted gross income is and what you're doing. So put a pencil. So I find that the easiest thing to do. I have many clients that do that. There are churches, schools, whatever. And it's a very easy thing to do. Everybody cooperates very nicely with it. People who are making charitable contributions have highly appreciated assets. I don't know why they would do it. Now, if you really love your stock, and maybe you want to keep 10,000 shares of Apple stock because for some reason it makes them feel good. He gave away the 10 shares. You could always go back and buy it. So if you want to spend $15,000, go back and buy the 10 shares, so we can look at it, $10,000, 10,000 shares. And when you look at what the tax implications are today, they're talking about no step up in bases, carryover bases, blah, blah, blah. Now, at least if you were to do it, you increase the basis of your Apple stock. You gave away the old shares, you had $10 basis, you took your $15,000, you went out and you bought 10 more shares, and you got now $150 share basis in your current one. So it's a real simple example, but you could have 100 shares, you could have 1,000 shares, depending on how charitable inclined you are. So I think that's another item that I see a lot of that going on. And you can get into more sophisticated assets, an interest in your business, your C Corp, your S Corp, maybe a partnership, real estate. You can do more things with those. They have more limitations. It's much more complex. I haven't really done any of those. You read about them, but people sort of like to have the control in their business. You say, well, you give it up, they're going to buy it back. I just haven't seen that. I don't know if Rob has or Lee has, but the thing I see most often is their contribution of highly appreciated securities.
Thank you. And, not all nonprofits, can accept gifts of stocks and other complex assets. And that's why the Community Foundation can facilitate that, for donors who want to give to other nonprofits as well. So while we're on the topic of using highly appreciated securities for charitable giving, I also want to talk about Charitable Remainder Trust, or CRTs. Charitable Remainder Trust, as you all know, that is another charitable giving strategy that allows converting a highly appreciated asset like stock or real estate into lifetime income. So first of all, I want to introduce Rob officially. He joined a few minutes later. Thank you, Rob, for participating in this panel. We appreciate it.
Thank you, Praga. Sorry for being late.
That's okay. You're with a client.
Yeah. So apologize for that, but thanks for letting me get on later.
No, that's fine. So that's why we waited, to ask you a question until now. So Rob, from an estate planning perspective, can you please provide an overview to the audience what a CRT, or Charitable Remainder Trust, is and how it works, what non-cash assets can be used, some benefits, and who you typically recommend it to?
Sure. Well, thanks for having me today. It's good to be on here with all of you. It's been, I got on right when Marie started talking, so it was great to hear from Marie and from Ray and from you as well. So thank you. The Charitable Remainder Trusts, whether you're doing an annuity or a unitrust amount, it's going to be depending upon what the individual client wants. And the benefit of that is that you can set it up with whatever assets you want. It can be cash, it can be highly appreciated stock, it can be regular stock, it can be real estate. It's got to provide some form of an income stream if it's just real estate, because you need to have some percentage coming out on an annualized basis. The benefit is that you don't get a full taxable gift for putting the assets into a trust, because if you're, depending on who the beneficiaries are during the lifetime of that, before the charity gets it, because there's two real types of charitable trusts that we typically create. One is a charitable lead trust, where the charity gets the interest for a fixed term of years, and then at the end of that term, the named beneficiaries would get it. And then a charitable remainder trust works the other way around. You designate who receives the funds for a fixed period of time and the payments out, and the charity would get whatever's left over. And it's at the time you make the actual contribution to the trust, to the charitable trust, I'll just be clear, it defines what your charitable contribution deduction would be, because you set it up and you just run in some calculations to determine what that percentage is that's going to be a charitable contribution and what would not be a charitable, would be part of that lifetime interest, or if your charitable lead trust is what the charitable contribution would be for that lead period of time, and then the gift is whatever the value would be at the time of gift for the remainder. When you're in a low interest rate environment right now, for clients that have estate tax situations, or even that are charitably inclined, there's a real great way to handle the dual system of a charitable lead trust and a charitable remainder trust together. Because if people are charitably inclined, you have the ability to create a charitable lead trust with a fixed amount that's going to go to a charity during, that, let's just say, 10-year term. And whatever's left over goes to your children or anybody else that you can set up as part of your overall estate plan. And then you do the flip-flop, as also on the charitable remainder trust, is what you think your kids might be giving up during that period of time, you give them during the lifetime, and then at the expiration of the period of time is when the charity gets whatever's left. So we get to use these a lot when you have a low interest rate environment. You can use both of them because of the hurdle rate of what you anticipate you're going to have to pay out of the charitable lead trust is going to hopefully, when the clients are planning, it's going to be less than what the assets will appreciate to. When you have a appreciating market environment and low interest rates, that the client can win on both sides because the charity gets money now, you get a charitable deduction. The amount of your gift is less, yet your kids will essentially still get the same amount of money or more at the expiration of that term because the appreciation outgrew what you had to pay out. On the charitable remainder trust, it works the other way around. Your kids get, or the defined beneficiaries get for that fixed period of time, the interest rate, whatever it is that you want to pay out, 5%, 7%, whatever it is what your kids would get, and then the charity would receive whatever's left over. You can do those during life. You could also set them up at death through your own testamentary type of provisions where you say, okay, when spouse 1 dies, you can create it. Spouse 2 dies, you create it. And then you can set them up that after death, you get them for a fixed period of time. The benefit is at the time of death, then you would get a charitable deduction for the contribution going into the charitable lead or the charitable remainder trust against your estate. If you're not in a taxable estate, it's a wash. There is nothing that you're going to get because you don't have a estate tax charitable deduction. But during your lifetime, as Ray mentioned, that there could be some advantages to you utilizing these type of vehicles and in an income tax efficient manner, yet still accomplish all of your goals. And because we're here with the Community Foundation, one of the great things that Community Foundation does is they help with all this, and they can help explain some of this to the clients if they think we're, as a lawyer, we're just trying to sell them something, because they can explain as well. And they can also receive the funds as a donor advised fund. The client sets up, that's a qualified charity of a charitable lead or charitable remainder trust. So not only do you get the ability to utilize a donor advised fund, which still gives you the flexibility to determine what charities you want to give them to during your lifetime and during that period of time, you still get the ability to have all the administrative, all the tax, all the investment taken care of by the Community Foundation. So you don't have to just list a charity like an American Heart Association. Right? Full disclosure, my wife works there, so I have to say that every time I use that as an example. You don't have to name them, the American Heart, as a charity of these charitable lead or charitable remainder trust. You can name the donor advised fund. So that still gives your client and the family full control over where these funds can go and what charities, what charitable purposes they're used for.
Great, thank you. And while CRTs are commonly thought of as like a lifetime planning vehicle, however, CRTs are also very effectively used on testamentary basis. You alluded to that. Rob, can you identify some opportunities and issues that surround creation and postmortem administration of testamentary CRTs for us?
Sure. So a few of my clients over the years, they have charitable intentions, and that, whether they have children or people they want to benefit, or if they don't, right, and they want to benefit charities at their death. They don't know how much money they're going to need during life, so they don't want to create a lifetime charitable trust. They want to wait until they pass away, and you can set it up underneath your will or a revocable trust. So you still manage those assets for yourself during your own lifetime. And then at death, we create that charitable type of a trust, whether it's a remainder or a lead trust. And, if we're not worried about estate taxes, because the exemptions of the clients we don't care about the charitable deduction at that point. It's just, you care about more of what are the intentions of the utilization of these funds. So clients that don't have any children, don't have any descendants, and they don't really want to deal with nieces or nephews or siblings or cousins, and they do have philanthropic tendencies and ideals. These are great tools to use. And when they don't have those designated direct heirs like a spouse or children, avoiding probate is a great way for them to accomplish a lot of goals and save a lot of time and money. So the revocable trust itself, where they have the assets in it during lifetime, and then when they pass away, we don't have to deal with the administrative costs of the probate, trying to find all these people. We just probate it through a revocable trust, which then sets up these charitable trusts at passing. It's very efficient. It works really well. Clients really like it because it accomplishes their overall goals, whether they have direct descendants or not.
Great.
Actually, can I just add into Rob? You know, I can think of one particular client that we've worked on recently where it was a case where they did have children. They did want to support those children with a steady income stream. You know, the charitable remainder trust will get created when they pass. The kids will have that lifetime income stream. And then, you know, that will allow them to have whatever's left in the trust continue on and do their charitable work after those children have used that resource for all those years. So,
yeah, that absolutely, Tom. It's that's a situation where a client has children that they don't want to give all this money to, whether they, I don't want to use the word trust their children, but if they don't want to just give everything to them, they still have a lot of strong philanthropic ideals, but they still know that their kids need some help. So that's where the charitable remainder trust, where you give the named beneficiaries a distinct payment stream. So they'll have income for a defined period of time or for their own lifetime. So it can be set up that the kids get X, percentage for their lifetime, and then when they pass, the charity gets what's left over. So it's also a great way, as Tom mentioned, to help provide for that extra layer of income for your descendants or for your named beneficiaries that can really work wonders for them, rather than just buying an annuity for them and naming them the beneficiary and then letting them dictate where the remaining assets go at their passing. Here it's set up, the parents, grandparents, whomever it is, siblings, they've set it up saying, okay, here, I'm going to give you 5% of this money for the rest of your life, but I still want money to go to these designated charities or to my donor advised fund, because this is my passion. This is our life's work, and this is what we really want, but we don't want to disinherit you either. And it doesn't have to be an all or nothing. I want to try and make that clear, is that just because you created charitable remainder trust at your death with your children getting some money, it doesn't have to be 100%. You can still give your kids 50% or 20% of your total assets, and the rest can go to a charitable trust, or vice versa. It's whatever your clients feel is the most comfortable to accomplish their overall goals, we can make happen. It's just having that open dialogue and open conversation about these types of opportunities that you have. And I don't know if this was mentioned just before I got on the conference call. Prior to the Tax Relief Act of 2017, I think it was like 85% of all charitable contributions weren't even deducted, because they're done because people feel that passion to give to the charities. It's not because it's all encompassing about an income tax deduction. As Ray mentioned, the amount of itemized deductions have drastically reduced since the Tax Relief Act. So now it's something like 90 to 92% of charitable contributions are not deducted. It doesn't matter that it can be deducted or not for most people. It's what is their overall plan and what is their goal. As long as you have that open conversation with your clients, there's so many different tools that we can do during lifetime planning, testamentary postmortem planning, and also advising the next generation, if they're open to it, about the pros and cons of why we do these types of things. Doesn't mean you don't love your kids because you don't give them every dollar at your death.
Hey, Rob, do you do anything with IRAs, these trusts?
So that's another good question with the Secure Act that was passed at the end of 18, where you have now the 10-year payment term at unless it's a survivor, and there's a couple other quirks to it, but in general, if you're naming children as the IRA beneficiary at your death, they have to take it out over 10 years. There are pros and cons to do that. If you can name a charity in to receive the IRAs, as you've talked about before, Marie and Ray, that you can give your kids after-tax dollars and give the charities the IRA dollars, because then it's a win-win for everybody, because now the government doesn't get the income taxes, the kids don't get stuck on their FAFSA form by getting, $100,000 extra every year out of an IRA distribution, and it messes up their financial aid. Whereas if you set it up and you have a charitable lead trust that's going to get an X number of dollars every year, and you know how much of the IRA you're going to put into it, you can draft these trusts so that the IRA can be the trust can be a qualified owner of that IRA at the death. Even though there's a 10-year payment term for most of them, you can include certain language that's going to require the distribution. And if you have a charitable lead trust, that income that comes out can have an offsetting income tax deduction depending upon all the different issues that you talked about, Ray, with income tax line limitations and things like that with the AGI. So there are different assets that we would want to fund with different types of vehicles. And it's all specific to the individual client. If every asset they have is IRA, okay, it's probably better to set it up where if they want the charity to get a specific dollar amount and they're okay with their kids getting payment terms over 10 years, then name the charity directly for the IRA so they get the money directly. But if you're okay with the kids getting payment terms over 10 years, then possibly the trust is a good way to do it.
Yeah, one of the main change from the Secure Act, and I want to give an overview what the Secure Act is, because we have some non-advisors in this audience as well. It's the Setting Every Community Up for Retirement Enhancement Act. That was the elimination of the stretch IRA that Rob talked about. It allowed a non-spouse beneficiary of an IRA to withdraw from the IRA over the beneficiary's life expectancy and stretching the benefit of the IRA into the next generation. So the Secure Act took that away, and a lot of advisors like Rob are suggesting CRTs to their clients who are looking to provide that security for their heirs after they're gone and benefit a charity as well. So have you had a lot of those scenarios, Rob, to start out with, and then Ray and Marie too? Have you had a lot of discussions around that since the Secure Act was passed?
Yeah, it's come in a lot more prevalently over the last couple of years because of that. We used to, have, name the charities, name the beneficiaries of your IRAs, go into a trust for kids, and you had a certain, language that you would include. Now, with clients, you always want to bring up the philanthropic and the potential for charities for the IRAs because of that 10-year limitation. It could be too much money to give outright to kids or to have them taxed on it. So there's a lot of different things that go into it. We've had certain clients that just say, I'm going to create a donor advised fund. We'll work with the community foundation to set up what our overall plan is, our story, what we like. And that's where we're going to put a majority of our IRAs, and we're going to do all our after tax in a non-charitable manner, because they have a certain amount that they want to designate for charitable purposes. And it may be better off to have just IRAs directly there, given the fact of the Secure Act, especially when you're, in a situation like myself, where now every few months you got to fill out these FAFSA forms for your kids in college, and every dollar you get from some form or another doesn't help in any way, shape, or form. And if so a parent passes away and they had $1 million in an IRA, that's $100,000 of taxable income that's got to come to the one child over the next 10 years. That could very well cause them to pay a lot more and not get grants, not get some scholarship monies, on the FAFSA forms. It can also, as Ray mentioned, it can throw people out of their senior star, enhanced star, or some type of benefits that they could be receiving. It could put them into a higher, put them into a higher tax bracket as well. So it really depends on the situation that you have with every client. But we've done, I don't know, probably since the Secure Act, we've done more donor advised funds or direct charitable named beneficiaries of the qualified funds than we did in the past.
Question. I'm beyond the FAFSA forms. So if someone had $1 million, you have the 10 years, but you take it out anytime during that 10 years. So let's say you have $100,000 that would normally come out annually, but you pass on it and just let it roll forward. Does that affect the FAFSA form because you actually have access to it if you wanted it? Run across that?
All right, a prompt came up and I clicked and I didn't hear the main part of your question. So
Well, we'll go back to your example.
Yeah.
You inherited $1 million IRA.
Mhm.
It's over 10 years. And normally you think I'm going to take out $100,000 a year for 10 years. But as we know, you don't have to take that out until the 10th year. So you
Correct.
keep letting it roll over, not pay any tax on the money you take out. So if you had to fill out a FAFSA form, does it impact the FAFSA form that you have access to the $100,000 even though you haven't taken it out? You just pass that, you let it roll.
Yeah, because in a FAFSA, you have to disclose all of your financial assets. And so you have to report all that information, at least, the first time I did it earlier this year, we did. And, that would be a situation where, now you have $1 million, so that's going to look like you can go get access to it. They don't care about the income tax consequence to it. So whereas what we traditionally used to do prior to the Secure Act, you'd create a trust to receive all that fund. So then it's not disclosable on the FAFSA form because you aren't the owner of it. But now with this money sitting in trust, the higher income tax rates on trusts, sometimes it's not the right place for those qualified monies to go. So that's why there are a lot of what's the right word I'm thinking of? There's a lot of options to really pursue. And that's why one of the things that I always recommend we do is have a discussion just like this with our clients, where we have the accountant, the financial advisors, the charitable people involved, because there are different facets to each that directly affect why we might do something over another. I could advise to do something on the legal sense that makes sense, but that's not what the investment goal is, or that's not what the tax goal is, or that's not the charitable goal. If we don't know what it's all about, or I'm looking at a screen with the four of us right now. So if we're all not on the same page, the client's disturbed, right? Because we want to make sure that everything that we're proposing and providing to the clients as a recommendation checks off all their boxes. And so, I think it is very important for us to have that type of situation where, we probably don't want $1 million just to be sitting in some child's name that has kids going through college, or in a sibling's name that has a potential to be getting some enhanced star, or different things like that. So there are different reasons why we would want to make sure we have all the I's dotted, the T's crossed, the financial advisor, the accountant, the charitable advisor. We are all on the same page with that client so that they know that everything is buttoned up as best as we can. Now, you bring a great question up on your statement, is that, all right, if you're in FAFSA for like myself, if we're in FAFSA for the next 10 years, or most likely 10 years, the way college is these days, we're going to need to fill out these forms. If I did receive $1 million IRA, would I just sit there and not take any money? So on the income side, it wouldn't affect me, and hope that the tax law changes again sometime in that 10 years. and kind of goes back. So maybe they do allow the stretch again. So there's a lot of these things that we just don't know. We have to go what's based upon the current law of the day and make the best educated recommendations to our clients at that time. And, you know, as we all sit here and talk, it's, you know, I think it's vital that we're all together on that.
Thank you for that insight. And Tom and a couple of other members in the audience here said, you know, advisor collaboration is key, you know, to serve your client in the best possible way. So thank you. Thank you for your time. It's past 1 o'clock and I want to take some questions. And one of the questions that I received and we meant to cover, I think DeRay and Marie talked about it a little bit, but someone just asked about, you know, what do you do when you get questions from your clients around establishing a private foundation versus a donor advised fund? How do you walk them through the pros and cons of each? And, you know, perhaps you've had some scenario with your client. Marie, do you want to take that first?
Yes, sure. So, you know, there are significant differences between the donor advised fund and the private foundation. Typically, I think the private foundation offers more control and is more family centric, and also typically involves a larger amount of money that goes on for a lifetime and perhaps several lifetimes. So there's more administration, there's more upfront considerations, I feel like, on the private foundation side versus the donor advised fund is a more simplified process for people to set that up and administer it, whether it be through the community foundation or otherwise. And there's also a lot of tax considerations when it comes to the private foundation that Ray can probably jump on and add to there. But there are pros and cons to both. So again, it's very specific to the client's situation as to what would be their best option.
I guess the first question I ask normally is how much do you think you want to put into a private foundation? And I think that's really a key issue because the expenses of managing a private foundation could really eat up a lot of the income. And it has a tax consequences of you have lower contribution limits as compared to adjusted gross income. So it's much more complicated. If they want to go that route and they have enough money, I tell them, you know, who's your attorney? Let's talk to an attorney that deals with these because it is complex. You want to make sure you don't violate the rules. The donor advised funds for modest amounts is so much easier. And you have a lot of flexibility there as well. But if somebody wanted to put, I don't know what the minimum might be, but I've seen some minimums and all you're doing is eating up. I'm sorry. I've seen some small amounts in private foundations and you're eating the thing up with fees, expenses, and fooling around with it. And the donor advised fund would be much more practical. So I would, you know, bounce over to Rob. Say, Rob, what would be, you know, a ballpark figure for a private foundation to even begin the conversation?
Well, I'll give you a little background is that people used to do private foundations all the time with 100, 200, 500,000, and because they felt that was the best way for them to control it. It's more expensive to create because you got to create the entity, then you got to file with the IRS, you got to fill out the 1023, and there's a filing fee for that. Then you got to get your New York CHAR form filled out and get that. So there's a lot more administrative things that's going to take into just to get it created. And in a time like we've had for the past year and a half, that time frame could spoil what some of their plans were for getting those deductions. So a donor advised fund for, you know, in the very beginning, if you just want to get your feet wet, are phenomenal, right? Because they're very low cost. Administratively, they're very efficient. You don't have to do your own tax returns for it. It's administratively just really smooth, the way, especially with the community foundation and the staff they have there, that they make it very easy and they let you write your own story for it. With the private foundation, as you asked, like, what is the amount? Well, if the plan is hundreds of thousands of dollars every year and you're going to build it up, then sometimes people, that's what they want to do, and that's where they feel it's better for them to handle that. I remember back in the day, I don't know, it's probably 10 or 15 years ago, where New York State tried to state that you can't have a private foundation unless it's $5 million or more, because of the administrative costs, as you mentioned, Ray, would eat up all the benefits of having the foundation if it was less than that. They didn't want people taking these advisor fees or management fees or director fees out of these smaller private foundations. When you have millions, as Marie said, and it's a perpetuity type of situation with families that they've been ingrained in that, sometimes that's what people want to do, like Bill and Melinda Gates Foundation. You know, that's hundreds of millions of dollars. I don't even, maybe it's billions at this point, I don't know. But, you know, it really depends on what the overall plan is. I think for most clients that are not worried about estate taxes, a donor advised fund is a great way to start. And not just because we're here on the Zoom with the community foundation. I think it's a great idea. Even smaller foundation, $200,000 or $300,000 in it, the administrative costs, sometimes it's better to merge it over, because they still get all the same things they want. With a private foundation, just they save a lot of the administrative aspect. When you're getting to be a large amount, some, you know, clients sometimes want all of that control themselves. They don't want to be limited in the sense of with some type of investment portfolio options that, you know, whoever they're setting the donor advised fund up with is going to limit to. They don't mind, you know, filling out all the paperwork and filing the 990s themselves. But is there a break point amount? Not right now, but you know, I don't think if you're going to be under $500,000 in total, I don't think a private foundation really is the way to go. If you're going to start getting into the millions of dollars, sometimes it's, you know, people like that because it's them and they don't have to report to anybody else but the, you know, their own filing. So that's kind of what we've done. You small ones you can convert. If you have a small private foundation, we've done that a few times, over to the a donor advised fund at the community foundation. It's been really, it's been very helpful. It's saved a lot of time and money. Sometimes when you have a small one, you just give all the money to the actual charity itself that you are benefiting or the purpose for it. I'm not a big fan of that sometimes, because then the overall purpose of keeping this there for a while and directing how those funds could be used, it's kind of extinguished if you don't convert it to a donor advised fund.
Thank you, Rob. Thank you to all our panelists. It is close to 1:15 now. So, we're so happy that you joined us to hear what this amazing panel advisors had to share about some of our popular charitable giving strategies and how they work with us at Community Foundation to help their clients achieve their charitable objective within their financial and estate plans. If conversations with our panelists today have prompted you to think about your own approach with your clients regarding charitable giving, or to learn about the Community Foundation, how we work with professional advisors in our community, please feel free to reach out to me. Dara can put my contact information in the chat box, along with Tom Griffith, VP of Development, and Jan Lane, another development officer. And so we'd welcome the opportunity to connect with you and help your clients. And thanks again to the panelists, to Ray, Marie, and Rob. Thanks for your time. I appreciate it.
Well, thank you, everyone.
Thank you.
And make sure for those who seeking CFP credit to fill out that CE form by the end of today and email it to me. Thank you.
Thank you, everybody.
Great job.
Bye.
Well, thank you. Thanks for having us. All right.